In other news, Equity Group plans to increase the proportion of its loan book that is attributable to micro, small and medium-sized business ventures to 82%, up from the current 72%. And this is according to the group's managing director, James Mwangi, who says that the planned increase is the basis for the partnerships with development finance institutions that the group has inked in the recent past. Judith Cherono has more.
The rush for lending to micro, small and medium-sized businesses is on. Commercial banks are inking deals with development finance institutions to provide longer tenured and de-risked lending to this otherwise shunned segment of the economy. Equity Group says it is eyeing such financing to help strengthen its balance sheet to allow it to take on more risk.
Because we are moving from commercial banking to development financing, because industrializing the East African region will require long-term funds for manufacturers. They require 5 years, they require 10 years of financing. We are now lengthening the maturity profile of our financing and creating a light mix of financing, blended finance, by mixing short-term and medium financing that the bank has with long-term funding from the development banks.
Equity Group says that its MSME lending strategy will be country-specific, with focus in Kenyan market being skewed towards agriculture, agro-processing and manufacturing. Financial services also stands out as an area of interest in lending within the Kenyan market.
Kenya chose financial inclusion. Kenya is now the most financially included country in the world with 89% financial inclusion. We focused on that. SMEs is our forte. No, it's forte. That's the competence and capability of equity. That is the underlying theme. Everything we do, we are empowering SMEs.
Rwanda, Tanzania and Uganda picked on logistics, hospitality, mining, among other projects that will be co-funded by the Equity Group in accordance to one country's competitive advantage. Judith Cherono, NTV Business.